With the passage of the Federal Reserve Act in 1913, the United States established its third central bank, which is still in existence after more than a century. But it didn't become the powerful, centralized, and independent institution we know today until later than you'd probably expect. The first Federal Reserve Board was inaugurated in the office of Treasury Secretary William McAdoo on August 10, 1914, right at the start of World War I. And in the first few years, each regional bank had their own policies, which were sometimes contradictory. In those years, the Federal Reserve Board in Washington, which was supposed to unite the system, was serving as a relatively minor appendage to the Treasury Department. The Fed only gained its footing as an independent agency during the 1920s, when it proceeded to help cause the stock market crash of 1929 and the resulting Great Depression. Good job, guys! During the New Deal, it was again eclipsed as America's most important financial institution with the establishment of the Reconstruction Finance Corporation. So it was only really after World War II, in the 1950s, that the Federal Reserve began to achieve the same level of prominence in American life that it holds today. But how does the Federal Reserve function? What does it actually do in the economy to help preserve the value of the dollar and reduce unemployment? How does it set interest rates? And does it actually create money? Let's get into it. Contrary to popular belief, the Federal Reserve doesn't have a lot of direct power over the economy. Don't get me wrong, it is a powerful institution, but it mostly operates by influencing what commercial banks do, which is where all the real action takes place. Let's start at the beginning. The Federal Reserve is a bank for other banks, if that makes sense. All banks, which are members of the Federal Reserve System, have a bank account at the Fed, just like you or I might have a bank account at a commercial bank. When we deposit money, these banks take our money, which becomes their asset. In exchange, they give us bank credit equal to the amount we deposited. When banks deposit money at the Fed, basically the same thing happens. Their deposits turn into Federal Reserve credit, which make up the bank's reserves. Back in the old days, banks were required to keep a certain amount of money on deposit with the Fed at all times, just like your bank might require you to have a certain amount of money in your checking account at all times, or you might be fined. For banks, this is called a reserve requirement. But as of March 2020, the Fed set reserve requirements to 0, meaning banks don't have to keep any money in their Federal Reserve account if they don't want to. Reserve requirements are one of the tools the Fed has in its toolbox to regulate banks, although the Fed has chosen not to use that particular tool anymore for the time being. The Federal Reserve can also lend to banks if it wants, of course, and whether they choose to lend or not is another regulatory tool. In a bit of jargon, when banks borrow money from the Fed, people say that they went to the discount window. The Federal Reserve has direct control over the interest rate it charges banks, which is called the discount rate. Changing that rate up or down is yet another tool in its toolbox. But the more important interest rate, the one that everyone pays attention to, is called the federal funds rate. That's the rate that banks charge other banks when they loan them money. So the Federal Reserve can't actually affect this rate, at least not directly. When the Fed decides to raise or lower the interest rate, it's kind of aspirational. But the way they try to get there is to buy or sell US government debt in the form of Treasury bonds or bills. When it buys or sells these bonds, that's called open market operations, which is just a fancy way to say buying or selling US bonds. When the Fed does this, it affects the interest rate. Let me explain. Treasuries have a price, which is how much they can be bought and sold for, And they also have a yield, which is how much the government pays you every month for holding on to them. Importantly, the price and the yield move opposite to each other, which is confusing at first, but it makes sense if you think about it. That's because if bonds are very popular on the market and everyone's trying to buy them, it's easy to see that their price will go up. More buyers or a lower supply of anything means a higher price, right? But in this situation, the government can easily get away with paying you less in terms of yield on those same bonds. They're so popular now that investors are willing to accept the lower rate. So, if bonds are very popular on the market, they will have a high price and a low yield. Okay? And the same is true in the opposite direction. If they have a lower price, they're not very popular, so the government will have to pay you a lot more every month just to entice you to hold on to them. So the yield goes up. By buying or selling a large volume of US bonds, the Federal Reserve can effectively set whatever yield, whatever interest rate, it wants to target, even if it's doing this indirectly through the actions of many investors. The yield on US bonds effectively sets the price of money nationwide, and that has ripple effects throughout the whole economy. For example, a low federal funds rate affects the behavior of investors in a particular way. It pushes them to make riskier and riskier investments because they can't make money anymore just by holding bonds. Some of these investments might be good for the economy, and some might be harmful speculation. But the point is that investors wouldn't want to hold bonds that don't pay anything. So the people with the money will be looking for other investment opportunities besides bonds when the federal funds rate is low. A high rate has the opposite effect. It drives investment money into bonds, which cools down the economy. That's because some investments that would have been positive for the economy might be starved of cash because bonds just become the better, safer option at that point. Another effect of a high federal funds rate is that people paying off mortgages and other debts will have to pay more in interest, which takes away their buying power. That harms the economy as well. So the conventional wisdom here is that you don't want to go too far in any one direction, high or low. So the Fed normally targets a federal funds rate somewhere in the middle so the economy will have moderate growth overall and a 2% inflation rate. Okay, so that's pretty much all the Fed ever does. Thanks for watching. Remember to like and subscribe, and oh yeah, we haven't talked about quantitative easing yet. That's kind of a biggie. Alright, you know how some people say the Fed, quote, prints money? Quantitative easing, or QE, is how they say the Fed does it. But in reality, QE is nothing like the printing of continental currency during the Revolution or greenbacks during the Civil War. In fact, it's actually very similar to the open market operations we just got done discussing. In these operations, the Fed buys US Treasuries to help it manage interest rates. This is a pretty normal and unremarkable thing for a central bank to be doing. But during QE, get this, the Fed buys US Treasuries to help it manage interest rates. Yeah, it's the same thing more or less. The main difference is the type of treasuries it buys. For QE, it's long-term bonds, up to 30 years for maturity sometimes, and it might also include some riskier assets like mortgage-backed securities. Okay, so that is a significant difference. These longer-term bonds or risky assets aren't quite as liquid as the shorter-term treasury bills. QE is kind of a euphemism for buying up junk. Anyway, in typical open market operations, the Fed is managing short-term interest rates, but QE helps the Fed manage long-term rates. So that's what QE is. But what are its effects? Well, just like with more typical open market operations, QE tends to push people with money to make riskier and riskier investments. And unsurprisingly, the stock market always seems to go up after a round of QE is announced. Some economists argue that QE is totally unnecessary and that its main effect is to juice the stock market, or the real estate market, as a way of enriching the already rich. Whether QE has positive effects on the economy over the long term is not completely clear.
Do you have any greater insight into what Fed bond buying actually does for the economy in terms of its economic impact? What is bond buying actually doing to help the economy?
Rates right across the rate spectrum matter for borrowers. So lower rates encourage more borrowing, encourage more economic activity. People, that you can service your debt, you have more free cash flow. It's not different from what we do at the short end. That's how it's supposed to work. And it's quite hard to be precise about these things because you only have one economy and you can't run two different economies right next to each other and do a scientific experiment. But most of the findings are that it does support economic activity in the way that you would expect.
The jury's still out on that one. But we do know the stock market likes it. And that's good enough for the people running the Fed. They've done it quite a bit. But don't worry, I'm sure the Federal Reserve governors don't have anything invested in the stock market. And they're doing this out of a deep conviction that it's the right policy. This video could end here, but I do want to try and fully answer the question of whether QE is the same as printing money. But before I answer that, let's define our terms. What I mean by printing is money creation of any kind, which today mostly means typing in numbers on a computer, not physical printing. And my definition for the word money throughout this series has been the following: anything which is often used to buy goods and services, or anything which is often accepted in exchange for goods and services. Notice that this definition excludes things like Bitcoin, because, you can buy things with it, but it's not typically done outside certain circles. Now let's take a closer look at open market operations. When the Fed buys bonds, short-term or long-term, where does it get the money? The answer is that, it creates it as needed. But there's no sleight of hand involved, and there's nothing morally wrong about it. When the Fed buys a bond from a particular bank, it credits that bank's Federal Reserve account. It's that simple. The Fed is basically saying, hey, we recognize that we owe you money because you gave us something of value. And I think we can all recognize that having an institution as powerful as the Federal Reserve, or the federal government more generally, in your debt, that's also something that's valuable to have. So yes, Federal Reserve credit is created as needed, as it should be. But is it money? On the one hand, of course it is. Banks use it all the time to trade with each other. But regular people don't have an account with the Fed. We don't use our Federal Reserve accounts to buy and sell things in the real economy. So in the short term at least, it doesn't really matter how much credit is in the reserve accounts of big banks. It doesn't have much of an effect on Main Street, just Wall Street. So, as we've seen, the Federal Reserve does create money, but just the money that banks and the financial sector use. It doesn't really create the money that you and I use on a daily basis. If not the Fed, who does create the money that we use? Someone has to, right? Well, it's the U.S. Bureau of Engraving and Printing who makes our paper money, and the U.S. Mint makes our coins. But that just scratches the surface. The institutions who create most of the money that we use every day are actually regular commercial banks and other financial companies like PayPal and Venmo. That's who really creates our money, not the Fed. Yes, PayPal creates money. Does. My account with them is just a record of what PayPal owes me. It's essentially an IOU tracker. To anyone who trusts in PayPal, this credit is money. It can be used to buy goods and services on the internet. And the same is true with any bank account. Let's say a checking account. What you have in your checking account, if you're lucky enough to have one, is not actually US dollars. I know, right? Crazy. What you have in there is bank credit, denominated in US dollars. It's a subtle difference, but when you deposited the dollars in the first place, the bank took them, right? They're not promising to give you back those specific dollars. What's important is that they recognize that they owe you money, and you trust that they would pay it back if you ask them to. That trust is the only thing that gives value to your checking account. That's the only reason why anyone would accept a personal check. They accept it because they trust you and they trust your bank. The second people stop trusting the bank, any money you have in it would disappear because it never really existed beyond that feeling of trust. A little off topic, but this is why the FDIC is such an important backstop to our banking system, perhaps even more so than the Federal Reserve. Everyone knows that there is a federal guarantee of deposits up to $250,000, and so no one worries about their bank anymore. We have public backing to the system, and that mostly stops our money from spontaneously combusting like it would do regularly throughout the 19th century. Our money is so much more trustworthy now than it was when we were on the gold standard. Next episode, we've got World War I and the Roaring Twenties. I will see you then.